Futures and options are two essential pillars of the financial derivatives market, offering traders and investors unique opportunities to manage risk, speculate on price movements, and diversify their portfolios. These instruments play a crucial role in modern financial markets by providing participants with the ability to gain exposure to various assets without directly owning them, while also enabling them to hedge against market volatility. In this comprehensive exploration, we will delve deep into the concepts of futures and options trading, understanding their mechanics, applications, and the nuances that make them such powerful tools in the hands of market participants. Futures contracts. A futures contract represents an agreement between two parties to buy or sell a specific asset at a predetermined price on a specified future date. These contracts are standardized and traded on organized exchanges, providing a regulated and transparent environment for market participants. Unlike options, futures contracts entail an obligation for both parties to fulfill the terms of the contract upon maturity. Mechanics of futures contracts. The mechanics of a futures contract involves several key elements. Underlying asset. Futures contracts are based on an underlying asset, which could include commodities like crude oil, gold, or agricultural products, financial instruments such as stock indices or interest rates, or even currencies. Contract size. Each futures contract specifies a standardized quantity of the underlying asset. For instance, a crude oil futures contract might represent 1,000 barrels of oil. Expiration date. The contract specifies a predetermined expiration date, indicating when the contract matures and the parties are expected to fulfill their obligations. Price or futures price. The futures price is the agreed-upon price at which the underlying asset will be bought or sold when the contract expires. This price is determined at the time of contract initiation. Margin requirements. Futures trading involves margin, which is a deposit made by the trader to cover potential losses. Initial margin and maintenance margin requirements ensure that traders have sufficient funds to cover potential losses as the market moves. Purposes and applications of futures contracts. Futures contracts serve various purposes and find applications across industries and trading strategies. Hedging. One of the primary functions of futures contracts is risk management through hedging. Businesses, producers, and consumers use futures to protect themselves from adverse price movements. For instance, a farmer might use corn futures to lock in a price for their crop, ensuring a certain level of revenue regardless of market fluctuations. Speculation. Traders engage in speculative futures trading to profit from anticipated price movements. If a trader believes that the price of an asset will rise, they might buy futures contracts, aiming to sell them at a higher price later. Arbitrage. Arbitrageurs take advantage of price discrepancies between related markets. They buy the asset in the market where it's cheaper and simultaneously sell it in the market where it's priced higher, thereby earning a risk-free profit. Portfolio diversification. Institutional investors use futures to diversify their portfolios, gaining exposure to various asset classes without having to physically own each underlying asset. Options contracts. Options contracts, on the other hand, provide the holder with the right, but not the obligation, to buy, in the case of a call option, or sell, in the case of a put option, an underlying asset at a predetermined price, strike price, on or before a specified expiration date. This unique flexibility distinguishes options from futures contracts. Mechanics of options contracts. Options contracts involve several key components. Underlying asset. Similar to futures contracts, options contracts are based on underlying assets such as stocks, commodities, indices, or currencies. Strike price. The strike price is the pre-agreed price at which the underlying asset can be bought or sold. It plays a critical role in determining the potential profitability of the option. Expiration date. Options have a specific expiration date, after which the option ceases to be valid. This date marks the end of the option's life cycle. Premium. The premium is the price that the option buyer pays to the option seller. It represents the cost of acquiring the option and is influenced by factors such as the underlying asset's price, volatility, time to expiration, and the option's intrinsic value. Intrinsic value and time value. An option's intrinsic value is the difference between the underlying asset's price and the option's strike price for in-the-money options. Time value is the premium beyond the intrinsic value and accounts for factors like market volatility and the time left until expiration. Purposes and applications of options contracts. Options contracts serve a wide range of purposes and are widely used by traders, investors, and institutions. Hedging. Similar to futures, options can be used to hedge against potential price fluctuations. However, options provide more flexibility since the holder can choose not to exercise the option if market conditions are favorable. Speculation. Traders can use options to speculate on price movements with limited risk. When purchasing options, the maximum loss is limited to the premium paid. Income generation. Experienced traders often sell options to generate income. By selling options, traders receive a premium from the buyer and assume the obligation to buy or sell the underlying asset if the buyer exercises the option. Risk management. Institutional investors use options to manage portfolio risk. Protective put strategies, for example, involve buying put options to limit potential losses in a portfolio. Comparing futures and options. While futures and options contracts share some similarities, they also have distinct differences. Obligation versus right. In a futures contract, both parties are obligated to fulfill the contract's terms upon maturity. In contrast, options give the holder the right, but not the obligation, to buy or sell the underlying asset. Flexibility. Options offer more flexibility to traders and investors. They can choose whether or not to exercise the option, depending on market conditions. Profit and loss potential. Futures and options both offer opportunities for profit, but the potential loss is different. In futures, losses can be substantial if market movements go against the trader. In options, the maximum loss is limited to the premium paid. Initial investment. The initial investment in futures includes the margin requirement, which can be substantial. Options trading involves paying the premium, which is generally much smaller than the margin requirement for futures. Trading strategies. Both futures and options enable various trading strategies, including spread strategies, straddles, and condos. However, the specific strategies used for each instrument can vary due to their unique characteristics. Conclusion. Futures and options are integral components of the modern financial landscape, offering traders and investors versatile tools for risk management, speculation, and portfolio diversification. These derivatives facilitate complex trading strategies, allowing market participants to profit from price movements while mitigating potential losses. It's crucial for individuals engaging in futures and options trading to have a solid understanding of the mechanics, strategies, and risks associated with these instruments. As financial markets continue to evolve, the roles of futures and options are likely to expand, adapting to changing economic conditions and investor demands. However, the fundamental principles underlying these instruments, the ability to manage risk and capitalize on market opportunities, will remain at the core of their relevance in the world of finance. As with any form of trading, individuals are encouraged to stay informed, seek advice from financial professionals, and continuously educate themselves to make informed decisions in the dynamic landscape of futures and options trading.